In this video, we are discussing about the credit control by the central bank, or you can say the money supply or control by the central bank. Due to economic fluctuation, the central bank, that is RBI, controls the money supply and the credit supply in the best interest of the economy. As RBI has to be the sole monopoly in the currency issue, it can control the credit and supply of money. For this, RBI makes a useful method for credit control. First is repo rate. Repo repurchase rate. Repo rate is the rate at which the central bank of a country, RBI, lends money to the commercial bank to meet their short-term needs. The central bank advanced loans against approved securities or eligible bills of exchange. And increasing in repo rate, increasing the cost of borrowing from the central bank enforces the commercial banks to increase their lending rates, which discourage the borrowers from the taking loans. It reduces the ability of the commercial bank to create credit. A decrease in the repo rate will have to be the opposite effect. Next, we are discussing about the bank rate or discount rate. Here we can discuss about that now. So this bank rate or discount rate policy. The bank rate is a rate at which the central bank lends fund to commercial bank, a lender of the last resort against approval securities and eligible bills of exchange. You can say like that the bank rate at a rate which the central bank of the country lend money to commercial bank to meet their long-term needs or short-term needs, whatever the requirement of their. RBI has to be actively using long-term. You can say that RBI has to be actively using bank rate to control credit. Bank rate has the same effect as that the repo rate. That is increasing in the bank and increasing the cost of borrowing from the central bank, which lead to increasing the lending rates by commercial bank. This discourages the borrower from taking the loans. So this which reduces the liability of the commercial bank to create the credit. This will then for the bank if they just want to grow their banking system only. So that is the main thing they have discussed about here for that. Now we are discussing about the next point, what the bank policy has used for the bank rate is known as the discounted rate, and it is the rate interest charged by the RBI to provide the fund or loans to the banking system. We not direct to them with the help of that. And then the funds are provided either to the lending directly or rediscounting the buying monies market instruments like commercial bills and the treasury bills they are doing. With the help of this figure, you can understand that thing. Next, we are discussing about the open market operations. What is open market operations? Open market operations refers to buying and selling of the government security by the central bank from or to the public or the commercial bank. RBI is authorized to sell or purchase treasury bills and government security. It does not matter whether the securities are brought or sold or to the public or banks, because ultimately the amount will be deposited in or transferred from the some bank. This will happen from there. So sales of security and purchase of security will done by both things done by the central bank. So sales of security reduce the reserve of commercial bank. It adversely affected the bank ability to create credit. Therefore, they decrease the money supply in the economy, and that will be harmful for the general people. So the purchase of security by central bank increases the reserve and rise the bank ability to the give credit. They will easily they will give credit to them. You can say like that there should be exist a well developed and organized security system in that the reserves of the commercial banks should be affected with the sale and purchase of the security. If you are we also, in the general public also, if they are selling our securities, so it will the falling in the prices, so that is called deflationary. And the central bank should hold the adequate security and influence money supply in the economy. There should not be frequent fluctuation in the value of the government, because the fluctuation, immediate fixed fluctuation, will harmful for the economy. So that is why for during the inflationary tendency, central bank sells the security to the public, and the bank a portion of the purchase power of the public and commercial bank. Cash flows goes to the direct central bank. With reduction in the deposits, lending power of the banking decreases, which leads to reduction in the credit expansion. So this has happened in the OMO, means open market operations. Like that, you can understand with the help of this figure. Uh, Most probably what happened when the RBI wishes to infuse liquidity into the market, it buys back the bond, and that are the with the investors. This is a bank. So what happened here, when the liquidity is good, interest rate is are lower, which helps the corporate borrowing at the cheaper rate. So they were doing like that. When the liquidity is more, the government can borrow at the lower yield. Otherwise, borrowing will be become expensive, and that is harmful for the corporate, for the business, for those who are taking the loan. So that is why. Next, we are discussing about the some legal reserve requirements and cash reserve. First, we will discuss the cash reserve ratio. The portion of primary deposit which the banks are legally required to keep with them, with the central bank in is termed legal cash reserve ratio, CRR. During rising prices or inflationary tendency, if CRR is rise, the lending power of the commercial realm will contract accordingly. This will cause the fall in money expansion in the economy. A decrease in the ratio has an opposite effect and may follow the during deflationary tendency. So what happened that you can say like that, it refers to the minimum percentage of net demand, time liability, and keep the commercial bank with the central bank. And the change of what happened if we change in SCRR affects the liability of the commercial bank to create the credit. For instance, an increasing in CRR reduces the excess reserve of the commercial bank and limits their credit creating power. So that is happened. Already I explained you for that. The 1,000 deposited, then bank is 940 and 160 rupees they will give for the as a CRR to the Reserve Bank. So this is CRR. Next है statutory liquidity ratio, which we are called SLR. It refers to the minimum percentage of the net demand and the time liability with which commercial banks are required to maintain with themselves. Actually, what happened? The SLR is maintained in the form of designated liquidity assets, such as excessive reserves, government and other approved securities or current account balances with other bank. So change in SLR affects the freedom of the bank to sell the government securities or borrow against them to the central bank. And increasing in the SLR reduce the ability of the bank to give the credit to us to others, vice versa, like that. So the Reserve Bank can influence the credit creation power of the bank by making the changes in either CRR or SLR. So that is the thing. Next, we are discussing about the main thing. It is a percentage of the total deposit commercial bank to have the invest in the government bonds and other approval securities. RBI in the November cut the SLR of bank for banks by 1% point. It now stands for 24% at the total demand and time deposit. Objectives of the SLR to restrict expansion of the bank credit are argument banks investment in the government securities and insurance of the why this done by the RBI. Can anyone tell me? Just I told you. Because they want to make the control on the banks, they have not ready to give much loans to them. If they are doing this type of things, that will be harmful for our economy. That is why the thing they have to be stop all these things they are doing. Like Reserve Bank is just controlling on the banks. Next is the repo and reserve repo by the RBI. According to the legal reserve requirement, commercial banks, what they are repo transaction on the conducting by the RBI in the money of the market. So what is in the short-term interest and the managed liquidity levels or short-term capitals, RBI just managing all those things. When RBI conducting the repo, commercial banks will approve the security to RBI with the repurchase or buy the back option on the specified time and period. With repo, RBI lends money to the bank and thus the extra liquidity into the money market. Repo rate is discounted rate at which the commercial bank sell government security to RBI by buying back option. So this is happening there. Now we are discussing about the some that um, according to reserve ratio, legal reserve ratio. So commercial banks are obliged to maintain the reserve. It is very quick and direct method for controlling and creating credit creating power in the commercial bank. Commercial banks are required to maintain the reserves from their different two accounts like that CRR or SLR. So now repo reserve RBI, if you can understand with this, liquidity moves to the bank and government securities move to the RBI. Reserve repo transaction, what happened? Government security is moved to the bank and liquidity moved to the RBI. So this is the repo and reserve ratio. Reserve repo by the RBI. When RBI conducts the reserve repo, commercial banks buy approval securities from RBI with to resale agreement in the future date and specifies price. So it will also control their things. Qualitative selective credit controls, fixation of margin requirements. Margin requirements is a difference between the value of the security and the loan. When central bank prescribed higher margin, the borrowers can obtain less amount credit and stocks, vice versa.